Just let me know when you're ready. Okay. Good. Well,
Sorry, so
fast.
fill Atwan, 10-to-1 exchange with exchange resources. Fill Atwan, go for it. Thank you for sharing.
Thanks,
screen.
Manny. Hello, everybody who's just joined us on the recording. I'm really happy to talk with you about this. As you probably heard back on April the 28th, the president created a speech, and the speech was to launch this program called the American Families Plan, which now looks like it's trying to get stuck into the infrastructure bill. The goal is to raise $3.5 trillion of new money to spend in a lot of different areas. But the big question is, where is it going to come from? Well, you only go where the big money is if you really want to tax. So guess where they chose? You're looking at them, each one of you in the area of real estate, whether it be your personal residence, a second home, a vacation home, or any kind of investment type of property. So here's how it works. It's going to affect anybody who has an income, including their investment property sale over $400,000, as opposed to long-term capital gain. It's going to go to ordinary income tax. So let me kind of show you what that means. So I'm going to go back a few slides on this. Currently, when you pay taxes, whoops, there it is. You pay between 15 to 20% long-term capital gains tax on the sale of your investment, commercial, residential, whatever it happens to be, property. Number two, you pay the 3.8 healthcare or Medicare tax for some people call it the Medicare, some people call it Obamacare. I don't really care what you call it. The bottom line is you have to pay an additional 3.8 if you're single, any gain over 200,000, or if you're married, a gain of 250 or more, you get an additional 3.8% tax to the 15 to 20% long-term capital gain. If you're in California, the properties in California, today it'll be between 9.3 to 13.3 cap on the state tax, in addition to the 20% and the 3.8 that goes to the state. Last year, the governor and the state senate tried to put in a new bill to raise the highest tax that we have right now in the country, would be California, from 13.3 to 16 to 18%. Unfortunately, they were not successful in passing that. But today, well, who knows what's going to happen in the future? Plus, you have a 25% depreciation recapture tax. As long as you have a building on that property and you're using it for business or it's income, you have an allowable depreciation to take. Well, when you sell that property, whether you took the depreciation or not, you still have to pay a 25% tax on all the allowable depreciation the federal government allows you to take. That's a pretty hefty bill to sell your property. Of course, they also have given us the 1031 exchange. So that defers the tax, but let's talk about that in just a second. What the White House proposed that is sitting in Congress right now, and Congress hasn't dealt with this yet. Why? Because it's a bomb that's going to explode in their faces, because they want to change. If you look at the top line here, the proposed increase to the tax rate is from 20% cap of the long-term capital gain to 39.6%. Here's my question. What do you think it's going to do to your real estate sales if you're going to sell a property and you have a 39.6% tax? NAR, CAR, not to mention all the other organizations of all the affiliates are fighting against this right now. But when you include all the other taxes, you're looking between, over 56.5% tax to sell a piece of property. So that's not good. The president has even mentioned that he would like to see this retroactive back to his speech when he gave the bill to Congress back of April 28th of this year, 2021. I don't think that will happen. I don't think they can backdate it that far, but the bottom line is anything's possible when you ask. Second thing is, as you know, when you pass away, the property will go to the heirs. In most cases, not all, but in most cases, if you have a trust, for sure, at a stepped up basis. So if you bought the property once upon a time for $450,000, now it's worth $12 million or whatever, the heirs would get a stepped up basis to the value of the date of the deceased. So the bottom line is they would take the property only at the fair market value the day that the deceased passed. Whereas if the deceased died, they would pay the difference in tax between that adjusted basis, right, at that $450,000 all the way up to the $12 million sales price, and they get stuck with the tax. But by dying in 1954, government allows us to have a stepped up basis, which means I die, Manny gets the property, he turns around, he sells it, he pays nothing, or doesn't get a tax burden because he's holding onto that property. Guess what? The American Families Plan that the White House has handed down wants to eliminate the stepped up basis, which means if people die and they've been taking money or cash by refinancing or whatever type of mortgage that they're trying to get cash out of the property, guess what happens? There may not be enough equity to pay for the taxes based on the elimination of this stepped up basis. This is a huge issue. Number three, the elimination or the gutting out of the 1031 exchange. That's right, that's a sacred cow. The exchange was created in 1921, which was 100 years ago, back in August of this year, for the purpose of deferring the sale, the gains of this sale that we just went over into other investment real estate. It's not a tax-free deal for the rich. It's a tax deferred event for anybody, whether it's a little single condo or a skyscraper in downtown Los Angeles. Investors can move their properties around by deferring the entire capital gain by reinvesting all the cash and buying roughly equal or greater for a 1031 exchange. The White House plan is to eliminate it first. Then they got all kinds of flack from all kinds of places. So they decided, okay, well, we won't eliminate it, but we'll just defer the amount of tax that you can defer, only the first 500,000 in gain. The rest of it, you will pay all those taxes that they're trying to raise. That is problematic for investment real estate or any kind of sale for that matter. So the bottom line is it also will affect opportunity zones for those of you who might be involved in it. So this is what happened. The House Ways and Means Committee met back in September, decided they cannot pass this bill. They didn't even have enough Democrats to get on board to pass it. Between the Democrats and the Republicans, they got together through this House Ways and Means Committee to say, how can we redo this bill to make a harmony and pass something that'll be good to stimulate the economy, not ruin it. So this is what they decided to do. Number one, this 39.6%, they're not going to make it in their suggestion to Congress is not to make it a ordinary income tax, but rather a capital gains tax. But instead of capping it at 20%, they're going to cap it somewhere between 25 to 27.5%. You say, Phil, that's a huge increase. It is, but it's not as bad as the 39.6% because the government wants to create more tax revenue on taxable sales. Number two, in addition to capping that regarding the stepped up basis, the House Ways and Means Committee said, you know what, we're not going to even put language about the stepped up basis. We're going to take out language of it. We're going to leave it as it is, which was very smart for them to do. The third item is no language regarding the 1031 exchange. So they're not going to put that language, the House Ways and Means Committee, in this new tax bill for the president. Now, remember I told you they're trying to raise $3.5 trillion? By any chance, do you know what that is? Can you fathom in your mind what $1 trillion is? Most people cannot. So what happened is one of my clients sent this to me and I thought it was very interesting. And I thought maybe this can help you understand what actually is $1 trillion and how does it work. So if I can just find it here, because I had it just a second ago. Oh yes, it is in, well, I can't find it, but as soon as I do, I'll give it to you. What $1 trillion is, and it gives you a measurement in terms of seconds for every dollar that's spent. What exactly is $1 trillion? So I'll get that to you in just a second. But the bottom line is this, is that the government is trying to raise the money. The House Ways and Means Committee is saying we can raise money, but not like that, because we don't want to kill the economy, then we won't raise anything. So this is what we're trying to ask you to do at this point. If you would just go to Congress by going to this website on the left-hand side on the bottom, it's www.1031taxreform.com. It will lead you to another website of which you can reply to Congress. And once you type in your name, it'll find out who your House of Representative person who's going to be voting on this, on the House Ways and Means Committee, or to go with the president's package, or to eliminate the whole thing whatsoever. But if you go to 1031taxreform.com, it will take you to a place where it will highlight who your senator and congressmen are, and you can tell them to vote no on that by, number one, keeping the 1031 exchange, number two, keeping the stepped up basis, and number three, if you're going to raise taxes, raise them in a smaller increment. Don't hit it all at one time, or you're just going to blow people out of the water. And the stock market and real estate will come to a halt. And we don't want to see that in our industry. So that's kind of what's happening in the industry today in terms of the 1031 exchange. And well, by the way, I found this $1 trillion thing, and I want to explain to you. They want to raise $3.5 trillion for these programs the White House has put down. So the question is, how much is $1 trillion? So if you were to convert a million, like if you're going to raise $1 million, if you convert $1 million to 1,000,000 seconds, how long is 1,000,000 seconds? Well, the answer is it's 11.5 days. 11.5 days equals exactly 1 million seconds. But if you were going to go to 1 billion seconds, how long would that be? That would be 31.5 years. What is 1 trillion seconds? It's 31,368 years. No, I'm sorry, 31,688 years. But that's 1 trillion. They want to go with 3.5 trillion. If you really need to talk to Congress about this, this is going to affect your business. I believe we could win this thing. I think it'll really keep the industry alive as we know it today. So the bottom line is keep it going in terms of letting the government know what's happening. In terms of what's happening in the industry, be careful when you take a listing on vestings. If the property is in a partnership name like a LLC or a corporation, remember the individual shareholders or partners of that property cannot do a 1031 exchange on their own. Why? Because they don't own the property. The S Corp, the C Corp, or the LLC owns the property and not them. So the bottom line is we can talk about that in more length at another time. Remember, the entity that sells has to be the same entity that buys in most cases. There are some exceptions to it, but that is a big deal right now. Other big deals are, the drop and swap and the swap and drop and how to deal with it. If you do have a group of people and some of them want to exit and some of them don't, and is there a way of doing it for the ones who want to keep going? So that is another issue that's going on out there, which investors can go their own separate ways and exchange, whereas the ones who don't, can they stay out of it? It depends on the way you have title to the property. Again, if it's in an LLC or a S Corp or C Corp, you can't do that. But if it's individual owners, you can. Be careful when you're dealing with people who are trying to buy. I got a call this afternoon before I got on with you. The guy wants to buy their relative's property. Can you do that in the 1031 exchange? Well, you can sell to a relative, but in many cases, you cannot buy from a relative unless the relative is also doing a 1031 exchange. You know why I'm telling you all this? Because you're going to work really hard to get that listing, to get a buyer, put it into escrow, and then you're going to call me or somebody like me to facilitate an exchange, and then they're going to tell you can't do it. All that work will go down the drain. So you really need to talk to whoever you're using for an accommodator before or after you at least get the vesting deed from the property you want to sell for your client. Because find out, can some of them go their separate ways or not? That'll save you a lot of heartache and a lot of anxiousness in escrow. So be careful of what you're doing. Make sure that your clients understand what is allowable and what's not. If you need help, call me. You can reach me at philatwan@gmail.com, or you can call me at area code 213-479-8255. 8800. I'm taking you to that last page right now. But Manny, is there anything else that you would like me to go over, with your people here right now in terms of, what's happening in the market and how it's going to affect real estate depending on how Congress goes or some of these other issues we mentioned?
First of all, thank you for that insight and information. It's always good to be one step ahead and understand the trends and what's going on. Some of it was news to me, to us, so that's good. Thank you for that. Really, just open. Let's open for questions.
Is there anybody who has a specific type of an exchange question they'd like to run by me?
Yeah, and you can just unmute yourselves. Whoever another question, or tap on the chat what you saw so far, what Phil was sharing, or if you have any other questions.
If somebody has a question, happy to do it. But I want to just mention one more thing.
Sure. Yeah.
What if, you're getting more and more seller carryback requests? I don't know if you've noticed that. When you have that, can you still do a 1031 exchange? The answer, it depends on how much you're going to carry back, because you have to still have enough to defer gain. If you're carrying back too much, it's ultimately going to be a real loser for the seller. Why? Because if they're going to have to pay 30 to 40%, 45% tax on money they're carrying back, because that's not going to go into the purchase. The bottom line is, I don't care what they're going to charge them for interest, even if it's 10%. It's a loser for them. So call me. There are ways to get around this. What the seller can do is bring in new cash of their own and lend that cash to the buyer, as opposed to funds coming out of their sale proceeds. Now they don't have to pay tax on that money, and they can do a full 1031 exchange. So there's lots of little ways to get around this. You just need to have a phone number to call or an email to shoot out. There's my contact information. I'm happy to get that to you if you don't have any questions now.
Good stuff, Phil. So thank you for sharing this information. So guys, open mic. Questions about exchange, comments about what you just saw. Well, we have Phil on the chat. Go for it.
Phil, I have a question.
Hi, Albert.
Hi. Regarding what's happening with the Congress.
Yes.
Again, unofficially between you and us, what is the chances of all this mess passing?
That's a good question. I know there's a lot of politics involved, unfortunately. Next year is a big election year for the House and the Congress and the Senate. And the strategy has been, at least it appears, that they're trying to pass as much as they can, as quick as they can, because they think they may lose the next election. In the event that they were to lose the next election, that means you might see a little bit more of a conservative type fiscal policies come into effect, where they're not going to jack up taxes in such a higher manner. They may increase some taxes, but not to that extent. That's why they're putting a lot of pressure. So to answer your question, is they're kind of running out of time, because the election is a year from now. So they're trying to get in as much as they can before that election. So the answer is they didn't do anything for over 6 months after being handed that bill, because they felt that it was like driving a suicide car loaded with dynamite. They're going to die in the process. They didn't want to die. So the bottom line is, I don't know. If we put enough pressure on them, I think they're going to back off and maybe go with the House and Ways Means Committee proposal that I just mentioned to you. That was a big deal for them to step up and say, no, that's too much. You can't do that. You're going to screw up the economy by doing that. And Wall Street, they're changing their diapers every hour, because they're afraid that the stock market is going to just crash and burn with those kinds of taxes. People are not going to invest that way in these types of investments. So I still think real estate's the best way to go. I think Congress understands that. I think ultimately they're going to raise taxes, but hopefully not too much. But when, I can't answer that question. My crystal ball, God, it's been broken now for, 20 years. I just can't get an answer on it. I pray to ask God for help, and I'm sure he hears me, but the bottom line is he hasn't given me any insights on what Congress is thinking.
And the other question I had in regards to, let's assume that you and me and another person own a property in an LLC.
Got it.
And let's say we want to go our ways and we want to sell it. And I quickly saw something about we have to dissolve that sometime prior to sales.
Right.
Could you please elaborate on that? How long?
I'd be happy to. That's an excellent question. And I get this quite a bit, especially in the commercial end of things. When you own a piece of property via an LLC, remember the LLC was created for limited liability, right? So they can't come after you personally, only the asset itself. So what happens is that's why we will start an LLC, you and I, when we buy a piece of property, so people can't come after us. But the problem is when you want to dissolve the asset and sell the property and do a 1031 exchange and go your separate ways or not, the question is, what happens? You're not going to go as an LLC. Why? Because you don't own the property. I don't own the property. Well, who does? The LLC. That's the owner of the property. So guess who can do the 1031 exchange? The owner of the property. So only the LLC can do an exchange. Now, to your question, Albert, can you dissolve the LLC and wait and then sell and do an exchange? The answer is in most states, 1 year. Unfortunately, the state of California said, no, it's going to be 2 years. And we can track this and we will audit this and you will pay the taxes on that sale because they require a 2-year seasoning period of holding the property after you dissolve the asset. Well, guess what? If you have a seller, they're not going to wait 2 years. So is there another remedy? That first remedy is called drop and swap. Drop means I drop the title. I dissolve the title. We have all of us who own the property now owns it as tenants in common. Can we have our own individual LLC held title as tenants in common? And then after 2 years sell? No problem, because the tenants in common are held by the different LLCs, or better yet, the LLCs are held by the tenants in common. So that's not a problem, and that is very, very doable. The second solution is, what if they all want to exchange, but they don't want to all stay together? Can they do it a different way? And the answer is yes. It's not going to be the drop where they drop title, wait for 2 years and then sell, swap, but it's going to be the other way around. It's the swap and drop. The swap and drop says that we will keep the LLC together. It will continue to work together. And it will sell the property and it will do the 1031 tax deferred exchange. So the LLC will sell and buy, if there's 3 of us who owns, then we will buy 3 different properties. Everyone will identify the one that they're going to eventually own. The LLC will sell and buy those replacement properties and then hold them for 2 years. After the end of the 24-month, now after owning these new properties for 24 months, then the LLC will dissolve itself, my property to me, your property to you, and maybe Michael's property to him. Now we have tenant in common ownership. I'm sorry, we have an individual ownership, because now that new property is in proportion to the amount of shares that I have in that LLC. So guess what? There's no tax in that situation. And you can do it that way, but you have to know how to do it. Second thing is, we have to have some kind of agreement that what property Michael's going to get, what property you're going to get, and what property I'm going to get will continue to stay the same, because at the end of 2 years, things can change. People can start arguing with each other and say, no, that property is actually doing better, and we did this as an LLC. Excuse me. So the bottom line is, it's better that they, number one, work with a good attorney, and number two, having some kind of a contract written up, so they know, everybody has no questions as to what's going to happen at the end of that 2 years, who gets what property and how much cash is allotted to them by the income produced by those properties during those 2 years. So that's how it works.
Hey, Phil?
I want you on that Ways and Means Committee.
Well, you know what? I have to run for
Thank you.
Congress first. I'm not sure I'm willing to do that.
Hi, Phil, this is David.
Hey, David, how you doing?
Pretty good. The question is that true for single member LLCs or for all LLCs?
No, remember, if you have a single member LLC,
Mhm.
you're the only taxpayer, so you can decide what you want. Now, there are two kinds of single member LLCs. One is called a disregarded entity. The other one is not a disregarded entity. The same is true for married couples in a community property state. In a community property state, you have two people who are married, right? And what happens is this husband and wife can start off a disregarded LLC or a non-disregarded LLC. What's the difference? Well, when you go to sell and then buy a replacement property, I don't know if you talked to a lender lately, but LLC financing is significantly more expensive. Sometimes what they want to do is acquire the property in their name and then afterwards deed the property back into the LLC, the new replacement property. That way they can secure the financing for that property under their names, but then put it back under the protection of the LLC. You can do that with a disregarded entity, but not with a non-disregarded entity. So they need to check with their CPA to see if it's disregarded or not. Usually the first hint to finding out if it is disregarded is how do they file their tax return. If they file a separate tax return just for the LLC, chances are pretty good it is not a disregarded LLC. But if they're filing that property within their own LLC as a single member or a husband and wife 2-member LLC in a community property state, then it is considered disregarded in their tax return, but a separate tax return, it's probably non-disregarded. So it's really important that they talk to their tax counsel to get that involved, because you and I don't want to give out that kind of legal or tax advice. But I'm going to tell you, it'll save a deal for you if it's disregarded or not, if it's a single member or husband and wife or multiple members, as you saw with the drop and swap and the swap and drop. So I suggest that you give me a call, maybe at the time that the client is considering selling the property. Let's find out what the situation is, and let's see if we can point you in a direction.
Thank you.
You're welcome. Any other types of questions? Carry back or anything?
Phil,
Go
can I
ahead.
ask one more question?
Please.
I want to, let's say, if I have an exchange request from a client, I want to make sure that assure him that his millions of dollars is safe with the company that this is being done. Could you please elaborate on that, how your company is handling, so we can all.
What I'm going to give you is good for any exchange company, and this is why you should put their feet to the fire on this. There's a few things that you have to look for, and you're asking a good question, because we've seen exchange companies owned by title companies or owned individually or owned by escrow companies crash and burn with clients' money. And some of abscond. I've even seen attorneys do that who have their own exchange company. They either take the money and run, or they bankrupt it, or they put the money in risky type of investments as opposed to putting it in the bank. And then the investment turns bad, and now they don't have the money to put it into the replacement property within the 180 days. So this is what you need to find out. Number one, do they put the money in a single client trust account at the bank, or do they commingle it with everybody else? That is a big deal, because when you commingle, that's the easiest way for thieves to take a laptop and to break in and be able to try to request to move funds. We've seen lawsuit after lawsuit, loss after loss. Never work with a company that commingles. always segregates individual accounts for every single exchange in the client trust account. Number two, make sure that account is never, ever a corporate account, because now it's corporate money. And if it's a corporate money and they overspend and all of a sudden, they're going BK and they begin the foreclosure process, guess what? Your client's money's at jeopardy because it's now held in a corporate account by the accommodator. Number three, make sure money could never, ever be taken out of that exchange account, that client trust account, without client's signature approving how much needs to go. That's really important because if the client signs off on it, the signature has to be checked. But if they're doing DocuSign, what we require upfront before the sale ever closes and we ever touch the money, we want the client's cell number. Why? Because if we get a request to move funds in writing, because we never take a verbal ever. In fact, we will not even verify funds to anybody without the client approving us to give that kind of information out. But if we get a request in writing and it's in DocuSign, we're going to call the client up and say, did you just recently ask us to do something for you? We're wondering if you can clarify that. And let's see if they talk and what happens. And the bottom line is that, and because we're not going to call the guy who's doing it, we're going to call the guy who we set up the exchange for to make sure that it's his authorization that he's requesting. Make sure there's bonding, there's errors and omissions insurance. Make sure there is also attorneys on staff. Some companies say, well, we have attorneys on staff, but the problem is they're escrow attorneys or they're title insurance attorneys. They're not 1031 people. So make sure they have good attorneys on staff that can help you talk to your legal counsel, the client's legal counsel, or to talk to their tax people if necessary, because some of these deals are extremely complex and you've got to make sure that the right hand knows what the left hand's doing. So everybody's on board. That's pretty much what you want, those items. That's as good as it gets.
Thank you, Phil. I appreciate that. Thank you.
Albert, anytime. They got to sleep well at night.
Yeah.
Somebody's holding their money.
Very true.
Yeah.
Good question, guys. Thank you. Phil, always good information, good insight. I appreciate that.
Thanks, Benny.
Bring news to us.
Yeah. Go out there, go to 1031taxreform.com. Go to the part on the upper right-hand corner where it says what is that? I forget what it is. It's upper right-hand corner where you can start responding to the government and watching what this
action. Take action. Yeah.
Take action. That's it. Thank you. You must have been there before.
Just
or I'm
now.
losing my mind. One of the two.
It's on the chat. The link is on the chat, by the way.
Yeah. It's a great way to go. Thanks,
Bye.
everybody. Happy Thanksgiving. I hope it'll be a wonderful time. I don't know about you, but I'm so grateful for these relationships I have with so many wonderful people that I work with. I'm so grateful for the industry that I'm in. We do so much good for so many people, you and I and escrow and title and all the other ones combined. Thank you for including us. We're honored to serve you.
Phil Atwan, thank you so much for your time as always and for the insight. Much appreciated. You can send a call if you want.
Thank you. I'm going to run to my next appointment. Have a good day, everybody.
All right. Thank you so much, Phil.
Bye-bye.
Would love to hear some insight. If you want to share some kind of coming soon pockets, whatever you